Philanthropy remains a cornerstone of addressing crucial social needs, but its capital structure is poor. Arthur Wood, founding partner at Total Impact Advisor, is joining us today to discuss impact investing. Arthur, welcome.
Good morning.
Now, the requirement is very large. I mean, the requirements for social intervention, social investment. It is poorly assessed. How large is it, and why is it poorly assessed?
When you look at the size, Nicolette, of the problems we face as a society, they're very substantial. If you think about climate change, 2 to 5 trillion costs estimated annually. Let me pick another: road safety, $650 billion annually. Water and sanitation, roughly $650 billion annually. These are just 3 issues. They are multi-trillion-dollar issues we face as a society. Juxtaposed against that is a real demographic crisis that we're faced in both the developing world and indeed the Western world, as you can see from the chart up on the graph here. And if we look on this graph here from the left-hand side, the United States, unfunded liabilities are estimated somewhere between $4 to $9 trillion. In the European Union, pension liabilities were not factored into the Maastricht Agreement, which means that if we look at Italy's case, for example, the debt is not 125%. People are fretting about it. It's nearly 325%. And if you look on that graph there, you can see in Japan's case, nearly, by the time my kids are my age in 2050, nearly 3/4 of the population are going to be over the age of 64. In the developing world, you have exactly the opposite problem. You have a huge growth in youth populations within, you take the bottom 20 countries, nearly 50% of those populations under the age of 23, which, unless we find a way of injecting the values of modern liberal capitalism into that marketplace, we are faced with considerable unrest. And it's when you look at that context, you realise that A, the demand and the ability of the West to pay for it on one side under the traditional mechanism, juxtaposed by the demands that are going to increase both because of population but also because of the core of these issues now coming to a head, leaves us in a position where we've really got to reassess about how we allocate and leverage capital. And
you believe that the structure of the capital market of social investing is very inadequate, very primitive. Why is that?
If you think about it, there are really only 2 mechanisms. It's May 1944, Bretton Woods, government knows best, and cascades the money from top to bottom. Something that since post-1979, certainly in the domestic economy, we would question. And then on the foundation world, which is the private allocation of capital, there's really only one vehicle in place. The bankers are the foundations. They allocate capital at -100% bilaterally for all intents and purposes. It's based on a fiduciary structure invented in 1903 by Carnegie and Rockefeller, crystallized in the American tax system in 1935 and a little twist in 1969, but essentially unchanged. And that's how 99% of capital is allocated in this marketplace. Now, you juxtapose that with all the tools that you would find in a modern commercial life, and you begin to get an idea of how inadequate the market is. But what the market does is show an absolute inability to scale. So let me give you an example. In the United States, it's estimated that the social capital market, the allocation of all social capital, is roughly $1.5 trillion. But in that marketplace, less than 0.0007% of those entities have reached $50 million of revenue or more, and only around about 3% of those entities have reached $10 million of revenue or more.
Well, it is what is shown on this graph.
Exactly. I mean, what you've seen is massive growth, but juxtaposed against that growth is an inability of the sector to move to scale. And that's because you have a capital market that is unleveraged and unannuitized. So you have all these organizations you have there trying to raise their income year on by year. They see their nearest person that they should be collaborating with as their biggest competitor. A lot of them create individual metrics to justify that bilateral relationship. So you end up in a marketplace, although it's a very, very pleasant sector to work in, but you end up in a marketplace that is very competitive in terms of how when they collaborate. And the incentives are not to collaboration, are not to scale. If anything, those incentives are a lack of focus on what their core issue is, because all the senior management spend time trying to raise their annual capital annually, and you're faced with a mechanism where they frankly don't really want to collaborate with the very organizations that they should do.
But there are now new models, and those models are based on some form of profit, at least some cash flows.
It's the word cash flow. You've hit the word exactly on the head. The social sector tends to avoid using the word cash flow. It uses the word sustainability. But at the end of the day, let's call a spade. Either government pays for it or the market pays for it. And what you've seen in the course of the last 10 years or so, and it's not because everybody's suddenly become massively open to these ideas, it's driven by the fact that money is drying up. And you can see that in terms of total aid flows, you can see it at a number of different levels, is that people have begun to look, as opposed to allocating capital at minus 100% or giving away, we can actually have models that we make money by actually investing in these opportunities. And that's, if you like, the move to social venture capital. Now, there's a third trend coming into play here, which is really interesting, which is an injection of a whole other range of capital market tools. And obviously we can touch on some of those. But what is called impact investing is quite simply the injection of modern capital market tools and modern legal structures into this space, creating structures that drive the sector to scale, reward innovation, and most critically, actually create the movement towards people collaborating and working together.
And one very good example is microfinance, which now everybody is familiar with.
Absolutely, and microfinance is the application of commercial banking. A lot of people think that's the be-all and end-all. But if you think about it, there's a range of other tools that are now being injected that are the next step on, in the same way that in the capital markets there's a whole range of different tools available. There are, for example, in the developing world, roughly $1.3 to $1.8 trillion worth of local currency pension funds. For the most part, those are invested in local government bonds and in cash. And the sums are quite substantial, as you will gauge. They don't go down to a Central African Republic, but they would go down to a Rwanda, 250 million, a Ghana, $1 billion worth. And one structure, which is a guarantee structure, almost pre-Bretton Woods in some senses, is a guarantee structure that would guarantee local bonds in local currency to invest in their own sustainable essential development. Social impact bonds would be another, very much the flavour in our sector at the moment, which I had a hand in conceptualising right at the very beginning. And what that essentially does is allow you to monetise the value of a social sector intervention. So it's called a Peterborough bond in the UK. Some of your viewers may have come across it. Let me give you the social problem, because it's a social issue that we're talking about here. The rate of reoffending of kids in gangs in New York, London is about 95%. And the standard mechanism at the moment when they come out of jail is to give them £100, £100 and say, don't come back. Well, they've been to jail, they go to the pub the first night, they drink it, frankly then end up in jail because there's no support mechanism for them. And there's a whole range of innovations you always find in the social sector, and assuming your idea makes it through government will nod its head at you and say, well, this idea to reduce recidivism is a fantastic idea, but who's going to pay for it, or whose budget do I cut to do this? And nothing happens. So under this particular structure, the British government makes a commitment to pay a third party, a high net worth individual, it could be an institution, a return based on the reoffending rate. So how does that work for all three parties? Well, for government, it's paid out of a contingent payment, so it's not a direct call, unless that saving is made out of police, hospitals, etc. For the corporate sector, or the sector investing, as opposed to being at minus 100%, they're actually getting a 13% return on the structure, and indeed it can be structured in a way that the quicker that social objective is achieved, the higher the return. So under traditional thinking, there is a fundamental contradiction between making money and doing good. Under this model, there is no contradiction. In fact, the extent to which the social objective is achieved, and achieved even quicker, the higher the IRR for the investor. Or for the social entrepreneur, the person who does it, they have access to a long-term source of capital. They have an engaged partner. So as opposed to spending 50% of their time trying to raise capital, they have that support. People generally also don't realise is that 98% of those assets are unaligned with social mission. You'd think they would be, but they're not. 98% of those assets are unaligned. Around about 5% is given away. And if you think how that capital works its way through, if 20% of that capital was to be aligned with the social mission, say 2% by the year 2020, so 20% by 2020, that would generate an investment pool of $125 billion. So this issue is not about money. It is really about us taking the tools that we understand in modern capitalism and applying them to this sector. It's about changing the way people think.
Thank you very much, Arthur. That was really impressive.